Have you ever wondered if your health insurance is actually tax deductible? The answer is yes for many business owners. But here's what surprises a lot of people. Two home care agency owners can pay the exact same health insurance premium and claim the tax write-off completely differently. Why? Because it depends on how their business is taxed. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. And today, let's clear up one of the questions I hear most often from business owners. How does the health insurance tax write-off actually work? As you've probably noticed throughout this series, the answer to many tax questions begins with it depends. Most often, it depends on how your business is taxed and whether your records support the write-off. Health insurance is one of the best examples. Let's start with sole proprietors and single member LLC. If that's you, your health insurance is generally deducted on your personal tax return. It can reduce your taxable income, but generally doesn't reduce your self-employment tax. That's an important difference many business owners don't realize. Now, let's look at partnerships. The deduction is still available, but the process is different. The partnership generally pays or reimburses the health insurance premium, reports it appropriately on the partner Schedule K1, and then the partner generally claims the self-employed health insurance deduction on their personal return. Again, same health insurance, different tax treatment. Now, let's talk about S corporations. This is where I see the most mistakes. Many owners pay their health insurance personally and assume that's enough. Unfortunately, that's not how the IRS wants it handled. I like to think of this as the rule of three. Step 1, get the premium onto the corporation's books. That happens because the corporation either pays the premium directly or properly reimburses the shareholder for premiums they paid personally. Step 2, report those premiums correctly on the owner's form W-2. Generally, that means including them in box 1 but not box 3 or 5 because they generally aren't subject to Social Security or Medicare taxes. Step 3, the shareholder generally claims the self-employed health insurance deduction on Schedule 1 or Form 1040, assuming they otherwise qualify. Miss one of those steps and you may not receive the tax treatment you expected. Before we move on, there is one important eligibility rule that applies to anyone claiming the self-employed health insurance deduction. If you or your spouse are eligible to participate in an employer-subsidized health plan for a particular month, you generally can't claim the self-employed health insurance deduction for that month, even if you choose not to enroll. That's because the rule is based on eligibility, not whether you actually participate in the plan. So before claiming this write-off, make sure you understand whether that rule applies to your situation. Now let's make this practical. Imagine two home care agency owners. Both pay $18,000 a year for family health insurance. One operates as a sole proprietor, the other operates as an S corporation. They pay the exact same premium, but they don't claim the write-off the same way. The sole proprietor generally claims the deduction directly on their personal return. The S corporation owner must first make sure those premiums are properly handled through the corporation, reported correctly, and then claimed on their personal return. Same premium, different process, because their businesses are taxed differently. Now, let's briefly look at C corporations. The rules are different again. Generally, the corporation provides the health insurance, the corporation deducts the cost, and the owner-employee receives the benefit under a different set of tax rules. The important lesson is this. The tax law doesn't simply ask, did you pay for health insurance? It also looks at who paid it, how it was paid, how is your business taxed, and how was it reported? Now, let's talk about documentation because this is the part that protects you if questions ever come up. Keep copies of your premium statements. Keep proof of payment. If your business reimburses you, keep those reimbursement records. If you're an S corporation, make sure your accounting, your payroll records, and your W-2 all tell the same story. Remember, good accounting isn't just about claiming a tax write-off. It's about building records that support that write-off long before tax time arrives. That's how you reduce uncertainty, that's how you gain confidence, and that's how you build peace of mind. So here's the big takeaway. Yes, health insurance can be a valuable tax write-off, but the correct way to claim it depends on your business structure. Understanding those differences helps you claim the tax write-off correctly, avoid costly mistakes, and keep your accounting records clean, organized, and audit ready. In the next video, we'll wrap up our tax write-off series by talking about employee training, licensing, and certification costs. For home care agency owners, investing in your caregivers is often one of the biggest investments you'll make. So we'll look at when those costs may qualify as business tax write-offs, what records you should keep, and how to document them properly. I'll see you there.